All right, welcome everyone to the Institute for Corporate Governance and Ethics Spring 2025 Speaker Series. I'm Todd Haw, Associate Professor of Business Law and Ethics at the Kelley School of Business and the Faculty Director of the ICGE. And I'm thrilled today to be joined by Michelle Lowry, the TD Bank Professor of Finance at the LeBeau School of Business at Drexel University, who's going to talk to us today about the blurring lines between public and private ownership of corporations. But before I formally introduce Michelle, I'd like to say just a quick word about the ICGE and some exciting changes that have occurred over the past semester. For those of you who have been a part of this speaker series in the past, you'll notice a few new things. So first of all, I'm a new face here, having taken over the directorship of the ICGE just a few months ago from June Yang. June was instrumental not only in creating the speaker series, but also in revitalizing the Institute for Corporate Governance at Kelley. So June, if you happen to be watching, the entire corporate governance community, and certainly me personally, offers you a sincere thank you for all that you've done and continue to do for the discipline. Secondly, you may notice that our acronym has grown. So we are now the Institute for Corporate Governance and Ethics. This edition is a recognition of the importance of ethical decision-making and behavior to positive and effective corporate governance, as well as the Institute's broader focus moving forward. So one that considers governance issues from numerous research areas, including traditional finance and management, but also corporate law, corporate compliance, business and behavioral ethics, and financial controls. And so to understand corporate governance, and particularly how to do it best, we've really got to take an interdisciplinary approach, one that breaks down academic silos and translates cutting-edge research to make it actionable to entrepreneurs, to business leaders, to judges, policymakers, and really anyone else interested in how our companies should best operate. So our new name, our new mission, vision, and value statements, which you can find on our new ICGE website, and the orientation of our work moving forward is going to reflect that approach. And in that vein, we're excited to announce that last November, we brought under the ICGE umbrella a network of academic collaborators from Ethical Systems. So you may be familiar with Ethical Systems. It was started by Jonathan Haidt at NYU about 10 years ago, and it has grown to be one of the best resources for business ethics research out there. The acquisition of Ethical Systems by the Kelley School not only doubled our research capacity, and it allows us to tap into the insights of a really, truly world-class group of academics studying business and behavioral ethics topics from a systems lens. But it opens up the field of corporate governance to a whole new audience. And so we're very excited to have the big tent of the ICGE get even bigger. So please stay tuned for all kinds of new initiatives and activities coming from the ICG and Ethical Systems in the future. All right, but let's not get ahead of ourselves too much, because today is about the work of Michelle Lowry, and her work, particularly the topic she's going to be talking about today, provides a wonderful example of how academic research can speak to the business world. Michelle received her PhD from the University of Rochester, and from there she taught at Penn State, INSEAD, and Wharton before joining Drexel's faculty in 2014, where she has also served as the academic director of the Raj and Camilla Gupta Governance Institute. Michelle has published more than 25 papers, many of which are in the top finance journals, topics such as IPOs, corporate governance, shareholder voting, and environmental and social issues. She has also held editor roles at the Review of Corporate Finance Studies, the Journal of Financial Economics, and the Review of Financial Studies. And she has served as president of the Financial Management Association, as a director of the American Finance Association, and as a director of the European Finance Association, as well as being a founding member of AFEC, the Academic Female Finance Committee, which strives for gender equality among the field of finance academics. So not surprisingly, Michelle's work has caught the attention of policymakers and the popular press. She has participated on SEC panels on shareholder voting, and is regularly cited in outlets such as the Wall Street Journal, USA Today, Forbes, and The Economist. So I could certainly go on detailing the many more accolades that Michelle has received, but I think I've delayed her remarks long enough. So with that, I'd like to welcome Michelle Lowry as our first Spring 2025 speaker. Please take it away, Michelle.
Thank you very much, Todd, for that overly generous introduction. I'd like to start by thanking Todd and ICGE for the opportunity to present today. I'm looking forward to it, and I'm looking forward to presenting my work as well as having a discussion vis-a-vis any questions you might have. Let me go ahead and share my screen here. Okay.
And Michelle, while you do that, I'll just quickly mention, if anyone would like to ask questions, we would welcome that and appreciate that. You can use the Q&A function, and we'll try to nudge you a little bit along as we go.
Perfect. Okay, so as Todd said, the topic for today is the blurring lines between private and public ownership. Let me begin with a big picture overview. As many of you are no doubt familiar, there have been dramatic decreases in the numbers of publicly listed companies. At the same time, though, we see increases in the number of private companies, and this includes increases in companies that are venture capital backed, that is, companies that one might expect would go public one day. So what explains this dichotomy, the decreases in public companies vis-a-vis the increases in private companies? On the one hand, VC-backed companies are increasingly getting acquired, but another dynamic is that VC-backed companies are increasingly staying private much longer. And it's this latter fact that I want to focus on today. The result of this staying private longer is that many private companies increasingly resemble their public counterparts. I'm going to focus on three dimensions of this: the sources of capital, the corporate governance, and the methods of growth. And then at the end, we'll talk a little bit about the potential implications that this might have. I'll note that much of the evidence that I'm going to talk about today comes from an article I published in the Handbook of Corporate Finance by the same title as today's talk. This is an outline of what we'll go through today. Let me go ahead and jump right into things, presenting first some statistics on how the numbers of public and private companies have evolved over time. So this graph shows the number of public firms from 1980 to 2023. As you can see, it peaked in the late 90s and has effectively decreased pretty steadily since then. A brief uptick in the early 2020s, but then again resumed its downward trend. If we compare this to the total number of firms, private and public, you see a very different pattern, with that tracking steadily upward. Now, of course, when we look at the 6 million total firms in the US, this includes many firms that would never go public. It includes dry cleaners, it includes restaurants, et cetera, et cetera. So let's look at another graph that shows just the number of companies receiving first round venture capital financing each year during this period. And strikingly, you basically see a similar upward trend. There was, of course, a big spike in the late 90s around the internet bubble, but if you disregard that one spike, you see a pretty steady upward trend throughout the period. Now, historically, venture capital-backed private firms have turned into and evolved some of the most important public firms in our economy. These graphs here look at companies, or are based on companies that were founded after 1968 and went public after 1978. So of that set of companies, that number of public firms, half of those were venture capital backed, as shown in the blue portion of this pie chart. Things are even more striking if we look at things on a value perspective. As a portion of US total market cap, approximately 3/4 represents venture capital-backed companies. We can go on. As a fraction of total R&D spending by public companies, 92% comes from companies that were venture capital-backed, and 93% of patent value represents companies that were VC-backed. So where does this leave us? Venture capital-backed companies are a key source of growth, innovation, and value, but fewer of these companies are going public, and many of them are simply staying private longer and longer. So what I want to think about today is, what do these still private companies look like? On the one hand, they're larger and older. How different are they than their public counterparts, and what implications does this have? Before jumping directly into those questions, let me just highlight that not only has the number of public firms decreased, but the importance of public firms along many dimensions shows similar patterns. On the left-hand side, you see the employees as a percentage of total non-farm payroll employment. What percent of total employees work in public firms? That was over 40% in the early 70s, and it is down around 25%, depending on exactly how you measure things, by 2020. When we look at value as a portion of GDP, again, we see a similar pattern. The role of public firms has diminished. Not surprisingly, there's been a lot of attention on why there's fewer public firms. This includes popular press articles. It includes research in academic journals. Obviously, I'm not going to go through each one of these. Let me just summarize. In aggregate, what's the evidence on why so many firms are choosing to stay private? I think there's four main explanations. First, there's simply more capital available to private firms, and I'll talk about that today. There's also confidentiality concerns for young, high R&D companies. They would rather stay private so that they don't have to disclose as much information about their business. Public firms also have greater sensitivity to product market competition, and so firms often stay private to avoid that type of competition. And finally, there's some evidence that increased regulatory requirements of public firms also contribute to more firms staying private. And I'm going to come back to those reasons at the end of the talk. Let's go in now, though, to the main things I want to talk about today, these blurring lines between private and public firms. And I'm going to talk first about capital raising. When we think of the sources of capital to private versus public companies, I think it's fair to say that a typical characterization of financing by these two different types of companies would look something like this. Among private companies, founders own much of the company, as well as angel investors and venture capital investors. At some point, this company goes public, and after going public, the company will have a much broader set of individual and institutional investors, and VCs will divest their shares. And those two stages are generally perceived to be quite different. What we're going to see, though, is that this characterization, quite frankly, is overly simplified as well as somewhat outdated. I'm going to start with some evidence on the extent to which investors such as mutual funds and hedge funds that we typically associate with public companies are increasingly investing in private companies. Let's look at this graph here. The white bars shows the number of VC-backed IPOs each year from the mid-1990s through 2016. The red line shows the percent of these IPOs that received mutual fund investment prior to going public. And what we see is that as of 2017, nearly 40% of venture capital-backed IPOs had mutual fund investment prior to going public. Now that goes through 2016. These patterns seem to have continued through more recent years. This is from Morningstar data. It shows the total mutual fund assets that are invested in private firm equities. The red line shows the number of mutual funds investing in private firms, and the blue bars show the total dollars invested in private firms. And as you see, the dollars invested, again, by mutual funds in private firms has continued to increase. We see similar patterns among hedge funds. Hedge funds are also increasingly investing in private firms, as shown by this graph here. So in sum, mutual funds and hedge funds are increasingly investing in private firms. As that has occurred, these private firms have found it easier and easier to raise more capital. This has caused the size of pre-IPO venture capital-backed financing rounds to increase quite dramatically. This graph shows this here. Let's look at the early to mid-1980s, the typical size of the biggest VC round. So that is the last VC round before a company went public, was something on the order of magnitude of $10 million. In contrast, as of 2020, the median VC round prior to the IPO was almost $100 million. When we compare the size of VC rounds today to IPO proceeds raised over time, we see that the median size of the last pre-IPO VC round today is greater than median proceeds raised in IPOs through the mid-90s. In sum, these alternative sources of capital have contributed to private companies raising more money without going public. And a result of that is that many firm types that were public in earlier years are now private. This is simply another perspective on this same underlying phenomenon. So the blue bars here show the number of companies each year that raise more than $100 million within the first 7 years of their first capital raising. You can see back in the late 80s, this was something like 500 companies per year. As of 2021, that was almost 4,000 companies that have raised greater than $100 million within the first 7 years of founding. Yet at the same time, as shown by this red line, a decreasing percent of these companies are going public within that same amount of time. So of course, the million-dollar question is why? Why are mutual funds and hedge funds, et cetera, investing in all of these private firms? You know, it's going to be hard, perhaps not surprisingly, to come up with one single explanation. So let me give you a bit of a chicken and egg view of things. On the one hand, the availability of more capital to private firms enables firms to stay private longer. It enables these firms to grow and mature more prior to going public. At the same time, the fact that companies grow and mature more prior to going public increases the willingness of non-traditional investors to invest. And we see this when we look at the types of companies that mutual funds invest in. So here I'm going to show you some graphs looking at the types of private companies that receive mutual fund investment prior to the IPO. Those are the blue bars, compared to those that don't get any financing from mutual funds prior to the IPO. Those are the red bars. So this first graph shows that the firms that got mutual fund financing prior to going public received more VC rounds total. The average syndicate size in these cases were greater. That is, these companies that are receiving mutual fund financing prior to the IPO tend to receive financing from more venture capital firms as well. They tend to receive more money in VC rounds, that is, they're larger, and they tend to be more innovative as proxied by the number of patent applications. So in sum, what do we have? Many firms today that are private, they're larger, and they've raised more money than public companies did in the 1990s. Moreover, many of these private firms also have relatively dispersed investor bases, as characterized by mutual funds investing in these companies, hedge funds, etc. Along many dimensions, these late-stage private firms are similar to public firms, or at least more similar than they were in the 1990s. Okay, so let's go back to this overall schematic. Are private firms that different than public firms? I've talked so far about the extent to which investors that typically invest in public companies, investors like mutual funds and hedge funds, are now investing in private companies. I want to switch gears now, and I want to provide some evidence on the extent to which investors that typically focus only on private companies, for example, venture capitalists and private equity investors, are also investing in public companies. So the first piece of evidence just regards the amount of time that a private equity investor holds on to a firm after that firm goes public. So here we're looking at a sample of companies that were private. They were owned by private equity investors. Those PE investors took the firm public in an IPO. What did those PE investors do after the IPO? Did they divest right away? Almost never. So less than 5% of these PE investors will invest right at the IPO. Even 1, 2, 3 years after the IPO, we see that many of these PE investors are still invested in the IPO. 3 years after the IPO, 40% of PE investors are still invested in that firm. In fact, this article by Jones, Jenkinson, and Rausch shows that in a quarter of private equity-backed IPO firms, the pre-IPO private equity investors still hold about 30% of shares a full 6 years after the IPO. That's a long time. Perhaps even more striking, not only are these pre-IPO investors taking longer to divest their shares, in some cases, they're actually investing more capital after the firms go public. So this graph shows the percent of IPOs in which the venture capitalist invested more capital after the firm goes public. And what we find is that in a sample of venture capital-backed IPOs, VCs invest additional money after the IPO in 15 to 20% of cases. Again, let me just highlight this. Not only are VCs not divesting right away, they're actually investing more capital after the firm goes public. I showed you before that when mutual funds invest in private firms, they tend to focus on those private firms that are more similar in some sense to public firms. We see a similar type pattern when we look at the types of public firms in which VCs invest. In particular, we observe that VCs tend to invest in public firms that are more similar along some dimensions to private firms. For example, looking first at the chart in the upper left, the blue bars show the percent of IPOs in which the VC invested more capital after the IPO. Those are the blue bars, whereas the red bars represent IPOs in which the VC did not invest more after the IPO. We see the cases with post-IPO venture capital investment tend to represent firms with negative cash flows. They tend to represent firms with higher R&D expenditures. They tend to represent younger firms, smaller firms, and firms with more negative ROA. Again, VCs invest in public firms, but they're focusing on the subset that are more similar along many dimensions to private firms. Let's extend this even more broadly by looking across all public firms. So this graph here shows some evidence on, it divides firms into deciles based on their net cash flows. And what we see is that firms with the lowest net cash flows, so the firms that have the most negative cash flows among all publicly traded firms, that subset of firms had net cash flows that were somewhat close to zero in the 70s, whereas those net cash flows equal negative 0.6, 0.7 as a fraction of assets in the 2010 to 2018 period. In other words, public firms are increasingly characterized by high negative net cash flows. These are firms that one can reasonably conclude will be harder to assess the true value of. Interestingly, these firms with negative net cash flows are increasingly raising equity, but these equity offerings are increasingly private placements. In other words, they're public firms, but they're often selling shares, raising equity from investors such as PE firms that might focus on private firms. Okay, so I've showed you a lot of pictures. Let me summarize what we have to this point. Mutual funds, who typically invest in public firms, are increasingly investing in private firms. Venture capitalists, who typically focus on private firms, also invest in firms after they go public. Public firms are increasingly characterized by firms with negative net cash flows, and these firms increasingly raise equity in the form of private placements. So what motivates all these investments, where investors are investing outside of what's historically been their main focus? To answer this, we can look at investors' returns. Let's look first at how mutual funds have performed by investing in private firms. This graph shows what's known as wealth relatives. That is, how much more did mutual funds earn in their investments in private firms relative to their investment in a market-wide index. What this shows is that mutual funds earn 2.5 to 3.7 times as much in their private firm investments as in a market-wide index. What about VC's returns to investing in public firms? We get a similar takeaway. Venture capitalists earn 30 to 40% abnormal returns over the 3 to 12 months following an investment in a public firms. Quite obviously, these returns are pretty striking. What about the underlying firms and their investors? So to get a sense of that, we look at the daily returns among publicly traded firms that receive venture capital financing. And we see that the market assesses these financings to be quite positive events for the firm. These firms earn 3 to 6% abnormal returns in the days around the announcements of these financings. In other words, the market assesses the value of the firm to be 3 to 6% higher after it receives this VC financing compared to when it did not. Interestingly, these firms, again, these public firms that are receiving venture capital financing, they tend to benefit the most in cases where a very specific set of venture capital investors are investing in them. Specifically, the benefits are greatest when the investor, that is the VC, has the greatest information advantage. For example, the venture capitalist has a director on the board of this firm. The venture capitalist owns shares in the company, or the venture capitalist invested prior to the IPO. Again, this is showing that the abnormal returns around the announcements of these financings are significantly higher in each of these subsamples where the VC has the greatest information advantage. The benefits also are particularly high when there's more uncertainty about firm value. For example, when the market has been performing poorly or when the market is more volatile. In summary, this evidence is consistent with many public firms representing firms that are harder to value in cases where an investor, such as a VC, that has a comparative advantage in evaluating the true value of that firm, coming in and providing capital. So to summarize, among private firms, when mutual funds and hedge funds invest, almost 40% of VC-backed IPOs had mutual fund investment prior to going public. Many of these firms had hedge fund investment while still private as well. Mutual funds benefit from these investments, and the underlying firms benefit as well. Turning to public firms, about 15% of VC-backed IPO firms receive additional VC funding after going public. And again, we see that both VCs and underlying firms benefit from these investments. Let me pause here. That's a lot of evidence on the trends in capital raising among different types of firms. Todd, anything that you want to sort of add here?
Yeah, thanks, Michelle. So we have a couple questions that have come in. I want to ask kind of a broader one first, though, sort of a clarifying question. So in your research or the research of others, do you see any differences across industry, for example? I mean, when I think of VC, I'm thinking about tech and things like that, or maybe biotech. Are you seeing any differences across industries?
That's a great question. So let's take, for example, the cases where venture capitalists are investing more capital after the IPO. There's a huge concentration in the biotech industry in this. Biotech industry is a case with very high demands for capital, and the firms simply have trouble raising as much as they need before the IPO. But then after the IPO, these firms are characterized by such high uncertainty. It's kind of
Yeah.
hard for your average investor to assess the value. So we see these very kind of specialized investors, the venture capitalists, coming in and providing that capital.
Yeah, let me ask one quick follow-up, but then I want to touch on some of the questions that have come in through the chat. Does it matter? I'm going to make an assumption that it matters who the VC investor is or not. And can you see that in your data at all?
Yeah, absolutely. So VCs are more likely to invest if they have a very specific information advantage in
Yeah.
evaluating that firm. So they might have invested in the firm prior to the IPO. They might have expertise in that industry. They might be sitting on the firm's board. It's definitely not a random VC that chooses to come in.
Yeah, and I mean, I imagine we'll touch on that when we think about the corporate governance implications of that going forward. But let me touch on a
Absolutely.
couple sort of more specific questions that have come in. This one's from Louise. What do you believe could be the effect of the reduction of public firms to pension funds? Is that something that you've considered or thought of?
Yeah, again, I think this is a good question. As fewer firms are publicly traded, a pension fund simply has fewer, set of possible firms to invest in. And the obvious question is, should a pension fund then start increasing its investments in private firms as a way to sort of expose itself to more sources of growth as well as to get a more diversified portfolio? This is a tricky question. There is some academic evidence suggesting the answer to that question is yes, but it is far from conclusive. And the reasons are twofold. One, the costs of investing in these firms are much higher. And two, there's simply less disclosure that these firms do. And so it's much harder to evaluate what their prospects are going forward. And this gets back exactly to what you were just asking, Todd. It's not a random investor that invests in these private firms. It's a firm with a strong information advantage. So to provide kind of an overview answer to the question, if you are a pension fund that has somebody with considerable expertise in this space, the answer might be yes, but you would not want to go into it without doing a lot of due diligence.
All right, we'll do one more quick one, and then we'll let you get on to think about corporate governance. Is there any correlation between the size of the investment and the size of the VC investment in the public company? Is there a break point where the dilution outweighs the value of VC's commitment that a VC's commitment brings? That makes sense.
Yeah, we do see that VCs have some, I mean, it's not a strict upper bound, but call it a rough upper bound in terms of what they want to invest. And there's two things that contribute to that. So typically, the late round VC has already invested in prior rounds. So they already have a lot of capital exposed to this one particular company. Second, as companies are staying private longer, the late VC rounds are getting larger and larger. And that's a large reason that these other investors can come in and provide value, these mutual funds and hedge funds, because they're providing that additional capital and therefore decreasing the amount that VCs need to invest.
Great, thank you.
Absolutely. Okay, so let me go on then and talk about corporate governance. So again, let's sort of step back again, thinking about this framework. How different are the governance structures between private firms and public firms? I think a lot of people think about a private firm as a firm with close control and little emphasis on formal governance, whereas a public firm faces regulations and external investor pressure that contributes to distinct governance structures. And the IPO is a bit of this breakpoint between the two. So let's go back though and think about it. So we just spent a lot of time talking about sources of capital, right? On the one hand, you might think historically, the sources of capital that a firm raised had this big break point around the time of the IPO. And that's what this left-hand graph shows, right? Prior to the IPO, in the years -3, -2, -1, you got no funding from investors that focused on public companies, things like mutual fund and hedge fund. And then after the IPO, you got all your funding from people like this. But what we actually see is that the right-hand graph is a bit of a more accurate description, that as the private company grows, gets closer to going public, you raise more and more money from these other sources. There's somewhat of a regime shift at the time of the IPO, but even after the IPO, you continue to raise some financing from these private sources. And so the question is, what about governance? Is governance also this kind of gradual change as opposed to an abrupt change? And what we're going to see is the answer to that is yes as well. So again, let me sort of provide some overview data, and then we can come back and think about what it means. So this shows the average board size over the years since the first VC financing. And so in the year of the first financing, called that year zero, your average board size is between 3 and 4 people. And that increases to about 6 people on average by 10 years after that first financing, but when you're still private. Perhaps more interestingly, we also see that the percent of independent directors increases over a firm's life while it is still private. So average board independence increases from about 17 to 31%. So as private firms mature, they're adopting governance structures that are more similar to those of public firms. At the first financing round, 37% of firms have 1 or more independent directors, and that increases to 65% at the fourth financing round. The question then is how much of private firms' changes in governance, such as board size and board independence, are driven by the fact that private firms of today are very different than private firms of the 1990s. They're staying private longer, they have more dispersed shareholders, etc. So to look at that, I'm going to compare the evolution of firms' governance after the IPO across firms that went public in the earlier versus later time period. And so here, this red dotted line, this is looking way back in time, okay? These are IPOs firms that went public between 88 and 92. And it shows how much the board size increased in the 5 and 10 years after the IPO. And you can see there's a pretty steep slope there. In contrast, if I compare that to firms that went public between 1996 and 2008, and then I follow those firms up to 10 years ahead of time, so going out to 2018, you can see that, sure, board size increases after the IPO, but the rate of increase is much slower. We see similar patterns when we look at the percent of independent directors. It used to be the case that the percent of independent directors increased a lot after the IPO. Now we see fewer of those increases happening after the IPO, suggesting that more are happening before the IPO. So in more recent period, the IPO firms' governance structures are closer to that of mature firms. These firms are maturing more prior to going public, and thus the rate of change in the years after the IPO is slower. So what about other forms of governance, in particular takeover defenses? We know that governance device of last resort is a takeover. For a private firm, typically a very small number of people have control of that firm, the founder, the early investors, etc. When a firm goes public, this typically changes. We have many new investors. The ownership percentage of the founder and early investors decrease, and the founders and early investors no longer have control. So a question I want to ask is, has this distinction changed? We know that ownership is already more dispersed prior to going public, and so given that, are the founders and early investors doing more to try to maintain control after going public? So I'm going to look at 2 types of takeover defenses. First, these are staggered boards. This blue line shows the percent of firms with staggered or classified boards, same thing, over a long time period. And you see that the percent of firms with this type of board structure has decreased markedly over time. Again, those are mature firms, so S&P 1500 firms. In contrast, we see the exact opposite among IPO firms. IPO firms are significantly more likely to have this type of takeover defense, these staggered or classified boards. We see similar patterns when we look at dual class. The percent of mature firms with dual class has decreased, whereas the percent of IPO firms with dual class has increased. So in more recent periods, founders and early investors are maintaining control after the firm goes public through the takeover defenses. The question, of course, is this good or bad, right, for the underlying shareholders? Let's think first about classified or staggered boards. Again, these are boards of directors where only 1/3 of the directors are up for vote in every year, and each director serves a 3-year term. You can argue that classified board enables a more smooth transition from private to public. So it's harder for an external entity to come in and try to take over the firm in a year, and that might be a good thing for private firms. It provides these private firms with a little bit of protection. It gives the founders some additional control, but not absolute control. And consistent with this, in a recent paper with Laura Field, we find no evidence that classified boards are value decreasing for these startup firms. In contrast, though, what about dual class share structures? Now, dual class share structures are interesting because when we look at them, we see they fall into one of two categories. On the one hand, among a subset of firms, we see that control, so the superior voting shares, are largely held by founders and insiders. On the other hand, there's a whole nother group of firms with dual class share structures where the control, that is the superior voting shares, are held by the parent company, for example, in an equity carve-out. And what we find is a very distinct difference between these two cases. When control is held by the founders and the insiders, these dual class share structures are not good for the underlying shareholders. They appear to be value decreasing. In contrast, when control is held by the parent company, these are in some ways more similar to a classified board. They're protecting the firm in the early years of being public as it more gradually transitions to being a mature public firm. And we find no evidence that the dual class share structures are value decreasing for that subset of firms. So again, to summarize, what do we have? Looking at sources of capital, we see a lot of mixed evidence. Mutual funds invest in private firms, venture capitalists invest in public firms. Very much this line between private and public firms is blurred in this space. We see similar big picture conclusions when we look at governance structures. Private firms, they adopt boards of directors that have many features similar to the boards of public firms. And after those firms become public, they adopt takeover defenses that preserve the control of those founders and early investors. So again, let me pause here. And Todd, if there are any questions or comments related to this idea that the corporate governance of private firms is becoming more similar to that of public firms. Again, I want to highlight, even in the absence of any regulation that forces firms to adopt these larger or more independent boards.
Yeah, so I'll just jump in with a few questions that relate to corporate governance. And this is one that I was really interested in. And here comes from an anonymous attendee. Is there a concern about access to insider information or asymmetry of information for pre-IPO investments?
Yes, is the short answer to that. The regulation in this space is really quite gray in surprising ways. It is quite stunning, right? That a venture capitalist who sits on the board can then come in and invest in a public firm, and they can buy those shares at a discount when they have a lot of inside information. If you find this alarming, I think that's probably on the right track. The only thing I can sort of present on the more optimistic side is we have a lot of evidence that these investments are very good for the underlying firms and their shareholders. So Are the VCs investing? Yes, they absolutely are. They are using their information, they are making strategic investments, and they are benefiting, but the more dispersed shareholders are benefiting as well, sometimes in very significant amounts.
Here's a question about disclosures, if you know. Do we know the type of disclosures that private firm investors are receiving from private companies today? Are mutual fund investors in private companies not getting audited financial statements at all? Question mark.
Yeah, good question. So the answer is yes. Typically, they do get audited financial statements. Most mutual funds that make a sizable investment. Okay, so this is going to differ if it's a very small fund. Let's disregard those just for ease of discussion. If it's a mutual fund making a fairly big investment, which is generally the case, they have what's known as advisory or it's board privileges. They don't get a vote, but they're able to participate in the board meeting and observe, excuse me. They have observational privileges. And so they will get the information, but they do not have voting power.
Okay. And I'll ask one, I got one sort of specific question, then kind of a macro question about the corporate governance implications of all this. But so this comes from Michael. Have you studied the use of sunset provisions for dual class share structures and how they impact the performance of the company?
Yeah, absolutely. So the sunset provisions, first, they're more common among those dual class share structures. That is a case where control is held by the parent company. So when it's an IPO that was an equity carve out, so the majority owner or the owner of those superior voting shares is the parent company, sunset provisions are very common. Uh, in contrast, when control is held by the founder and the insiders, the sunset provision is much less common.
Okay.
Um, so sunset provisions, they do make these dual class share structures less bad, but at the same time, it's important to recognize they're also concentrated in cases where it's the parent company that owns the superior voting shares, not the founder. So there's two things going on together, and it can be a little bit hard to separate the two.
Yeah. And Michelle, I'll just ask kind of the, the $64 million question here, which is, on the whole, is corporate governance, better or worse off with this the new trend that you're identifying here? I mean, it seems like there's a lot of push and pull, some positives, some negatives, but just what's your sort of gut on, how corporate governance is operating as a whole in this new regime, if you will?
Yeah, I think that's a great question. And there's two things I would comment. First, as evidenced by sort of this kind of graph here, boards are increasing their size prior to the IPO. They're becoming more independent after the IPO or before the IPO, excuse me. The fact that this is happening in the absence of any regulation highlights the fact that private firms recognize that they are becoming bigger and more complex, and they have increasing demands for governance, and they are voluntarily adopting these new governance structures to account for that. That is a positive. It's also something that all private firms of, this is what people are doing on average, but not every private firm is recognizing this. So, a takeaway for private firms is if you are getting bigger and more complex, your old governance structure is not going to cut it. You need to make sure that you get the appropriate people in there advising things. That's the glass half full view of things, I guess. Being balanced, the glass half empty view of things is that after the IPO, we have a lot of founders out there that have a lot of power. And in some cases, these founders are using their power to adopt governance structures that maintain that power for them long after the IPO. This is particularly alarming in the dual class scenario. And when we observe these cases with dual class share structures, where the control is held by the founder, where we typically do not observe sunset provisions, that is value decreasing. And that's the negative takeaway.
Great. Thank you.
Absolutely. Okay, so let me go on then to the last part of the talk. provided a lot of evidence so far that private companies increasingly resemble their public counterparts. They raise large amounts of capital. They have governance structures such as larger and more independent boards. The last thing I want to think about is, do they also grow like public companies? And in particular, I want to look at their frequency of doing acquisitions. Specifically, do they make acquisitions only after going public, or are they also making acquisitions prior to the IPO? And I'm going to divide these data into different time periods. Let's start first with the 1980s. Here, the blue bars show the frequency with which companies did an acquisition, either 4 years, the lightest blue bars, 3 years, 2 years, or 1 year prior to the IPO. And as you can see, during the 80s, for companies that went public in the 80s, we see almost no acquisitions pre-IPO, and then a big increase in acquisition activity after the firm went public. We push forward into the 1990s, we start to see some changes here, right? 2 years, especially 1 year before the IPO, we have more firms doing acquisitions, but the biggest spike still is in the year after the IPO. Going forward into the early 2000s, that difference between the number of acquisitions done the 1 year before the IPO, that is the dark blue bar, versus the first year after the IPO, the light pink bar, is getting smaller. And then among firms that went public in the more recent 2010 to 2016 period, you see almost no discontinuity in acquisition activity. Again, this is just one more piece of evidence that private firms increasingly resemble their public firm counterparts. And consistent with that, they're growing both organically and inorganically via acquisitions. So where does this leave us all? Conclusions and implications. Private firms increasingly resemble their public counterparts. They're staying private longer. In terms of ownership, they raise more capital. They have more dispersed ownership. In terms of corporate governance, they're larger. They have more independent boards. And in terms of methods of growth, they pursue more acquisitions. On the other hand, when we look at public firms include a lot of firms that are more similar to those that used to be private. We have more firms with negative net cash flows that tend to be harder to value. They raise more capital through private placements, and they raise capital from intermediaries specializing in private firms, for example, VCs and PEs. And so why does this matter? As I thought about this, I tried to divide it into different constituencies. Let's start with public firms. For public firms, I think the most important takeaway is that much of the key competition comes from private firms, and that's potentially worrisome because private firms tend to disclose less. In other words, among public firms, the key sources of competition are simply less transparent than they used to be. What about private firms? For private firms, one takeaway is you don't have to go public to raise capital. There are more and more sources of capital available to private firms. However, as you grow, it's imperative to consider factors that were previously emphasized only after going public. For example, what is your optimal governance structure? How many directors do you need? How many independent directors do you need? And how should you grow? Should you be looking for acquisitions as a source of growth? What about regulators? Private firms are not subject to the same regulatory structures as public firms are. Disclosure is where we see this most, but there are other dimensions as well. Because private firms are out of the public eye, they simply raise the attention of regulators less often. And as more firms stay private, this is something that regulators should think carefully about. And finally, for investors, and this relates to the question raised before from somebody from a pension fund, as more economic output is in the private sector, should people be investing in these firms? And that's a really important question. And to be frank, the evidence is mixed on this at this point. There are more barriers to investing in private firms, and there are more risk to investing in private firms. And so it's particularly important that you have the relevant expertise and do sufficient due diligence. So that's all that I have to say. I will stop there and be happy to answer any questions.
Great. Thank you, Michelle. There's a few questions here that have come in. I want to touch on them, and then there's a great closing question. So I'm going to hold that one for just a second. And so this one came in from Harry Engler earlier on. How does private credit fit into your analysis? There's been a lot of attention focused on them in recent years, if you've thought about that.
Yeah, sure. Private credit is in many ways exacerbating the trends that we are seeing here, right? Just as private equity firms are increasingly investing in public firms, we see similar trends in private credit. And just as the concerns regarding less transparency that we have on the equity space, the increasing trends to private credit, again, exacerbate those same things. And so if we take a big picture view of this, from the both intermediary side of things, that is the providers of capital in both the equity and the debt space, and in terms of the firm side of things, that is whether firms are private or public, we're seeing more activity in the private side of things, that is out of the public eye where there's less transparency. And that changes the game for a lot of players.
Here's another question that came in a little bit earlier. Is it true that most of the differences that you're talking about in investments reflect the lack of opportunity in public companies and the excess of funds available for mutual funds to invest?
It plays a role for sure. And there's two things that are contributing to this at the same time. So first is the decreased number of publicly traded companies, as you highlight. The second is the increased assets in equity index funds. And so those two trends combined sort of hampers in actively managed mutual funds. They have fewer investment choices and they're increasingly have to compete against these index funds. And in order to address these sort of dual challenges, they're going into private firms to try to invest there to gain a unique advantage. And an interesting sort of side effect of all of this is that there are more mutual funds that want to invest in private firms than there are private firms that want their investments, which is sort of a perhaps puzzling takeaway. But as a private firm, you want the capital, but you also want the advice. And the reality is that VCs have a lot more advice to give, and that's valuable.
Yeah. I think we're going to be, rewriting or rethinking some of our governance textbooks, as these blurring lines become a little bit more apparent. We've got a couple minutes left, but I think we'll close maybe on this question because it's a bit of a macro question. It says, based on your evidence and analysis, which hypothesis about the decline of public firms, private capital availability, disclosure risk, disclosure cost, would you favor?
Oh, that's a tough one.
That's why we'll make
I,
the last one, Michelle. You can punt too if you'd like.
um, I'm not going to pick one, but I'll pick a couple. How's that? No one could operate in isolation. So if we had a lot more capital available to private firms, but the benefits were so much greater of being public, for example, lower costs of capital and increased publicity and increased availability of contracting with both employees and with suppliers and customers, a lot of these kind of benefits that are traditionally given of being public, if all those benefits were still just as large, then that increased capital in the private space wouldn't play any role. Let me flip things around. If you had all of a sudden the benefits of being public were smaller because you had these increased regulatory costs and you have these high disclosure costs and everything else, but there's no capital available to private firms, then that's not going to be sufficient either. And so it really only works because you have both of these things working in tandem. You have increased capital available to private firms, and you have these macro changes in our economy where more and more firms are high-tech firms. They have high what we call information asymmetry. It is not clear where their sources of value come from. They want to protect their competitive secrets, their intangible capital, et cetera, and they can do that better by staying private. And so the firms stay private to avoid the disclosure, and the availability of capital makes that possible. So hopefully that's not too much of a punt for you, but I do firmly believe that that's where the evidence points.
Well, and I think that tees up kind of these longer term trends that, you know, we'll see and see how they develop over time. But it doesn't seem like that particular one is going anywhere anytime soon. So, Michelle, I
Agreed.
think with that, I think we'll close things out with a heartfelt thank you to you for participating in our speaker series. I'll also just mention to those that are listening online, first of all, thank you for joining us. This is the first of our spring 2025 speaker series. So essentially every month we'll have a new speaker coming along, try to touching on all these different areas that I mentioned at the outset related to corporate governance and ethics. And so please stay tuned. Check out our website, the ICGE website, where you'll find the list of additional speakers, but also links to Michelle's other work. We'll put the slides up, and if we can rope Michelle into answering a few of the remaining questions, we'll do that, because I think the sign of a good discussion is you have way more questions than you have time to answer, and that is certainly the case here. So thank you again, Michelle, and thank you all for listening.